What's up, everybody? Thank you for tuning in to another episode of the CPA Zone, the podcast where we discuss tax strategies and accounting tips for entrepreneurs and real estate investors. My name is Ryan Pulis, and our company, the Pulis Group, offers tax planning and advisory services for entrepreneurs like you. Whether it's bookkeeping, tax planning, or CFO services that you're looking for, we've got you covered. What's up, everybody? Welcome back to another episode of the CPA Zone. Today, we have two special guests with us, Jeff and Bill Horan. They founded and run Realty Exchange Corporation, which is the largest exclusive intermediary in the Mid-Atlantic region. And today, we're going to be talking about 1031 exchanges, cover some of the basics, and then talk a bit more about the strategy that we call drop and swap. Jeff, Bill, would you guys like to introduce yourself and give a little more background?
Sure. All right. Who's leading, Jeff?
Sure. I guess I can go first. Jeff Horan, we're obviously 1031 qualified intermediaries, and as a family, we've been doing this for a long time. So I'm a third generation qualified intermediary. I think there's maybe only a couple of us out there who are still doing this as a family. So I can't call myself a founder because that was my grandfather who started the company back up. And then shortly after that, or not, I say shortly, but not too long after that, my father joined. So I have been doing it obviously less time than him. I had a stint doing my own thing for a while in the working world before I pivoted and changed careers and jumped into this. But my focus now is on 1031 exchanges and keeping the family business going.
Awesome. Good.
Yeah. So our little business is 35 years old. Hard to believe in this niche space. Most of our market is Mid-Atlantic because that's where we sit. And we do a lot of teaching real estate agents and the public, et cetera, on 1031 stuff. So that's really our focus, DMV stuff and down into North Carolina. But we have clients that swap stuff all over the place. So the exchanges are all over the country. And once clients figure out what this is and they understand where the basic bumpers are, and they do it over and over again. So we live on our repeat clients coming back to us.
Okay, awesome. Yeah, I'd say 1031 exchange is probably one of the most tried and true, oldest strategies out there for real estate investors.
Right. I would agree with that.
Yeah, with a lot of folks are doing cost segregation studies with bonus depreciation, but for a while that was phasing out. That just came back. That's a popular strategy, but the 1031 exchange, like you really, those are your two main
bread and butter.
Yep. Even with opportunity zones are pretty nice where they allow that deferral, but you're still paying capital gains. You're kicking the can down the road. The 1031 exchange allows you to just completely defer depreciation, recapture, capital gain. And I realize you guys know this already. I'm kind of speaking for the listeners, but you keep kicking that out. And if you go the drop till you swap, or swap till you drop route, you can pass that property on to your heirs and lock in those tax
Right.
make them permanent tax savings.
Yeah, it's a real powerful tool, right? Be able to pick up the investment, move it somewhere else, right? And then with very minimal cost, rather than your normal transaction costs, and just move that investment and split it up, moving to different types of properties. For an investor, it's a powerful thing. Change your investment entirely, but keep the same investment, right? Without being locked in and by having to pay the tax bill.
Yeah, absolutely. So I figured maybe we kind of just start a bit, get into what exactly a 1031 exchange is, cover the basic rules that go into a typical delayed exchange. I can kind of start, and then maybe if you guys want to fill in anything, kind of get into some places, like areas where maybe you see people run into issues most often. So, with a typical 1031 exchange, you're going to have the two clocks that kind of run concurrently. You have your 45-day identification period and 180 days to close on your new property. We've got to use a qualified intermediary because there can be no constructive receipt. That's where you guys come in and help clients out. You handle all that paperwork for them, kind of take receipt of the funds, disperse funds when necessary, and make sure the transaction runs smoothly from beginning to end. You will be the recipient of their identified properties. You kind of take that, put it in their file, make sure that they've met the timing windows. And then the other rule being the exchange properties are of like kind, which today means real estate for real estate, and they tend to follow local real estate laws for that. Did I miss anything? Same taxpayer that same taxpayer that gives up a property needs to be the taxpayer that acquires the new property. And there are some things that like the drop and swap, I hope we'll touch on in a bit, that help taxpayers make sure they stick to those rules.
Yeah, I mean, the basic exchange is a trade of properties. There just happens to be a gap in time in ownership. There's other ways to do delayed exchanges, but nobody does them because you have to have friends help you do stuff like that. And the government created the role of qualified intermediary to bridge that. And so some of us have businesses. That's what we play, is this middleman role to bridge you from the old investment to the new. And like Jeff mentioned, think of it as moving the investment somewhere else. You're just giving up this one. You got to have somebody like us in between so that you're not gaining from a sale. So we're stepping into the transaction. And then, we take the proceeds from the sale. So you don't benefit from the sale. You don't get anything. And then you pick out what you want, and we have your money and we buy it for you, and you end up owning real estate. So that's the basic premise. You gave up real estate and you still own real estate when it's all said and done in this window of time. I think one thing to add to what you're mentioning is the idea behind exchange to not pay taxes, replace that investment value. So if I use a very simplistic example, it's a $500,000 sale and there's no debt on it, right? I'm just selling this rental townhouse and there's no debt on it. If I sell it, I'm going to pay my fees to get out, transfer tax, commission, stuff like that. So maybe I'm down to 450 by the time I pay all those fees. The premise of the exchange is move the money to the new property.
Yep.
So as long as I buy something for 450 or more on the buy side, I spend all the money, then you're good to go. You didn't gain anything in between ownership, right? So
Right.
there is an adjustment for cost to get in and out of these things. It's part of the equation. But the basic premise of an exchange is replace the value of the investment and put all the money back in, and you won't pay tax because you just moved it all someplace else. And like you mentioned, and like I'm going to hammer on here, you're moving everything. Your basis, which you have in your property, that's your original cost, and that basis adjusts every year, right? It goes up for new dollars in and down for depreciation when it's a rental property. That's going to carry over with you to the new property. You're continuing the investment. I'm going to use that word a bunch, continuity of investment. And that's the premise with Congress is, wait a minute, you're just continuing your investment at a different location. You're not cashing out. You're not benefiting in between ownership. So you just move it. And that's the basic premise of an exchange, continuity of investment.
Yeah, no, I totally agree. And you see that in several of the court cases involving 1031 exchanges. That they will refer back to like the intent of Congress at the time was to allow taxpayers to simply move their investment from one place to another. They're not receiving any benefit at the time. They're just continuing their investment. And that's where that.
And a good example everybody falls back on is farmers. They used to trade land all the time. And why is this not taxable when they trade? In the old days, farmers would just swap acreage.
Yeah.
There was no money. There was no cash in the middle of that transaction. So how do you tax something when there's no money, when you're just trading properties? So that was the basic premise. And what are the values? Because the farmers know the values, but nobody else knows the values. So that premise of that not being a taxable transaction has been out there forever. Well, since the 20s, right? Since the beginning of taxes.
Yeah, in fact, I can't remember what the code section used to be. It's like 201 or something.
Yeah, way back.
That.
Yeah.
Then they changed that. I don't know if that was the 50s around that time when they changed it.
Oof, man, now you're testing my memory.
Yeah, I'm just kind of trying to go what I think I recall, but really not important because now it's 1031, has been for a long time, and will likely continue for the foreseeable future. So, but so we just kind of covered the basics on a typical delayed exchange. I have talked in the past about something called a drop and swap. And recently you had shared with me a court case out of New York State. I think it's Hadar and Shamron, if I'm saying that right.
Something like that.
They essentially dropped into the tick structure in exchange right away, where a lot of times you hear people, the advice, the standard advice had really been to have some time in between to show investment intent. And they did it. I believe it was the same day, or was it the next day?
Same day.
It was very, very, very quick. They won that case, and the exchange upheld. And in that case, I also believe they kind of went back to that. The intent was, you're just moving your investment to another place. The change in the entity is because you cannot. What one of the issues when you're in a multi-member LLCs, you can't exchange an LLC interest for another LLC interest. So typically taxpayers drop into a tick structure and use that tick structure to hold the real estate and then swap that and complete the 1031 exchange. And they did it all on the same day. It was good to see they won. It is a New York State case, not a federal tax court case, but it helps shed a little light on where the thinking is going there. Do you guys do do you see a lot of drop and swap transactions come through your firm?
Yeah.
Yeah, somebody's in an LLC, and the definition of 1031 just by law is real estate for real estate. And if I'm in a multi-member LLC, that's a partnership by definition. It has its own tax ID, files its own tax return, et cetera. And so it can do the exchange, but not everybody wants to be partners anymore. I want out, somebody doesn't want to participate, whatever. So you want to, somebody wants to do an exchange, you got to be in an ownership of real estate to trade the property. And so what we see is, maybe a partnership dissolution where they break up the partnership and redeed the property tenants in common, or maybe they're buying out a couple of members and putting them as tenants in common, and the LLC owns a smaller tenant in common percentage. There's different strategies around this thing. The difficulty and where the issue comes up is the language of 1031 says you can exchange property that's been held. So if you make a change of ownership down at the courthouse right before the sale, the argument's always been you haven't held the property individually. Let's say there's three of us who are partners in the partnership. We dissolve the partnership right before the sale, redeed tenants in common, and then we sell the property. We've only owned it a month or so. And so that's a short holding period, right? And what was fascinating in the court case was, and so most of us have always, at least try to rejigger your ownership before you got a contract to sell, put a year of time so it shows a year on your books as tenants in common, blah, blah, blah. This one, they buried it in the sale contract. It was part of the sale contract that their intent was to hold as tenants in common. And they didn't do the actual physical drop and deeding until right before closing. I think it was the same day. They deeded out of the LLC and then immediately sold it. But in the sale contract, they had signaled, triggered, whatever intent was to sell it as tenants in common. And that was enough of an argument against New York. And they won, and the judges bought off on it.
Yeah.
So
yeah.
that's the issue is you're changing the ownership with a drop and swap right before the sale. And part of what comes up is when you when you report an exchange on the 8824, which is the document that reports 1031 exchanges, it's got the date on there. What date did you give up the property?
Yeah.
And so it's the government sees that ownership period right there.
Yeah.
So that's part of the dilemma is it shows up somewhere. Also on partnership tax returns, page 2 down near the bottom, there's a couple of questions. Did you drop somebody out to tenants in common?
Yeah. It's
And now I think there's a new form that the government just started last year that you got to send a new form in. Did you pull a partner out of a partnership?
Yeah.
And so now there's a bunch of places that change of ownership, if that's the right word to use, shows up.
Right.
So, I mean, I think overall it's a for our conversations, and yeah, this comes up a lot, right? It's such a common scenario of a couple.
Don't want to be partners, right?
Yeah, we don't, maybe we still like each other, maybe we don't, right? But we want to, go our own way. So it becomes a risk conversation of, hey, here are the factors here, right? You got to meet this intent requirement, which is key for the 1031 exchange. Hold the property for investment. But if you drop right before, have you held it for investment? And it's somewhat of an open question. So unfortunately now, circling back to the New York case, we've got, at least a method for these taxpayers or a potential tool to use to help show that, right? Oh, this is something that might work. So it's going to be a factor in the conversations that people have with their tax advisors when they're approaching these things.
And a key component that was in that court case is they had all signaled early on they were going to drop the tenants at common.
Yeah.
So part of what we run into is, we're headed for settlement. There's a contract of sale. Nothing mentions anything about changing ownership in the sale contract. And then they go, wait a minute, we got a giant tax bill and I want to trade. Well, they haven't done any of that pre-intent stuff. So that just makes your case weaker. We know what you're doing. You don't want to pay taxes. So you're going to take a couple of steps to get out of it. Right? So that court case was key in that they showed intent. We all had kind of known that, but now we got a court case to point to.
Gotcha.
Yeah.
So, just inside baseball on some of this stuff is the expert witness was a guy named Brad Borden, which we know. He's a great guy. He's a law professor. He writes a lot on 1031 stuff. And he has written an article in Tax Notes, which is where everybody goes for their tax stuff, about there is no real holding period. So he was the expert witness for the client that was selling against New York. Well, New York's going to have pull out the big guns to go up against Brad Borden. And so that worked really well for them. And so he was the right guy to sit there and argue because he'd already written an article about it. But he can't find in the code what is held for. What does that mean? There's nothing out there that defines that. We've all just implied that means time, but that doesn't necessarily mean that, right? Because there is no time in 1031, a holding period. Nothing's defined like that.
Right. Didn't they ask the agent in that case, like what they thought the holding period was, and they just said maybe a couple of months, some very, very vague, like
right.
on nothing.
They don't know. They're going up against one of the geniuses in the 1031 business. So it's just perfect, right?
Yeah, exactly.
Perfect. What will be fascinating is to see if the federal government looks at that case. They're watching. There's no ifs, ands, or buts about they're watching because this has stirred up our industry because now we got something to point to.
Right.
A New York court case, you can point to it. And so it'll stir our market up. It'll be interesting to see if the feds come in and look at it. My personal guess, they're not going to look at it. They don't care about this stuff, but that's my personal guess.
Yeah. It's hard to say with those guys.
Who knows, right?
Yeah. And it kind of leaves us the lay of land, right? We have a couple different states that we have litigated this, right? So we obviously have a good case out of New York, which is precedential in theory, right? But we also have a couple, bad cases out of California. So typically in our, we're chatting with clients is one of the factors here is we don't see a lot of this at the state level in terms of scrutiny on these types of transactions, just anecdotally, right? No, we're not CPA, so we wouldn't go through the audit with you, but where we see, visibly is New York and California, right? Where at the state level, they were really challenging these things. Now we got a good case out of New York, but California is still a challenge, right? Is that there's a lot of scrutiny there. So it from talking to our clients, the tax advisors will give different opinions on, hey, should we approach this strategy depending on where you are, right? So in the Mid-Atlantic region, we don't see much at all in terms of state level looking at this kind of strategy or taking an opinion on it. But now we have an interesting lay of the land where some discrepancies depending on where you're selling.
Gotcha. Yeah, that makes sense. California it get difficult over a whole lot of issues, but
especially 1031. Yeah.
Because 1031 is very specific in doing certain things, right? And so I think California picked up on, hey, this is easy pickings for them when they want to audit somebody because somebody could easily make a footfall somewhere in there.
Yeah.
And then they get to blow up the whole thing and collect cash. So I think New York called him and said, "Hey, how are you making some money?" And 1031 came up. That's my theory, conspiracy theory. Right?
Yeah, that's a good one. I know with the more traditional drop and swap, where they kind of drop into that tick structure a bit beforehand, there's often some complexities, or I guess loose ends that need to be dealt with, where they have to figure out how to collect rents, because you can't have all the activity running through the former LLC if you drop everything into a tick structure. And there's a lot of legal documents, leases might need assigned, a lot of I's to dot and T's to cross to do it properly. I had heard somewhere that when you drop into this tick structure, sometimes they will kind of set up a separate operating entity to assign the leases to and collect
Like a
rent.
management company. Right?
Management company, yes, exactly. That way, they can kind of have the business run still, but they're not in a traditional multi-member LLC partnership structure,
Right.
including the real estate that's owned over here in the TIC, but the activity, the operations are over here in this management company. Is that pretty common with
Yeah, very much
dropping
so.
stuff? Okay,
Very much so.
Yeah.
And when you drop the tick, you're supposed to have a tenant in common agreement, right?
yeah,
Because there's multiple owners. You're supposed to have some sort of agreement between you all to do that stuff. And it's all, sometimes partnership structures can get very confusing. There's waterfalls, there's, who gets paid first, all that stuff. Tick structure is not that way. It's, I own a 25% interest. I get 25% of the rent,
yep,
25% expenses, et cetera. So it's a different structure, but you're supposed to go through those steps to do all that sort of stuff. And the other thing that people run into is lending. If there's a big old loan on it and you change the ownership, the lender may not like that. You have to go get the lender's permission. You're going to sell the thing, so maybe you don't tell them about it until the last minute. All those, because lender's going to say no matter what. It's their
yeah.
job. So it's there, like you said, there's a bunch of parts and pieces to rejiggering the ownership. And now we have this court case that sort of says, well, you don't necessarily have to go through all that crap to get to where you want to go, or you hopefully, right?
Yeah. So all these pieces circle back to that original thing, right? It's an intent requirement at the end of the day, right? To
Sure.
hold for investment. So the thought is you have to have you have to show that bona fide business reason, right? To change ownership. And when you change ownership, there's good reasons to manage a property in a partnership, right? Makes it a lot easier. It has all kinds of different ways to, pay out the partners as Deb mentioned. But when you drop the tick, that's a very different ownership structure, and there's a very different way to do it. So there's some of those tools, right? Use a management entity or something like that, right? To then be able to still operate almost like a partnership and get some of those same things. But the key thing is you still got to do all the bona fide things. You can't just redeed the property into tick and not do your tick agreement, not redo the leases, not do all that stuff. Because then that opens it up to, hey, did you really intend this, right? Or
Right.
were you just doing it for taxes, right?
Yeah, exactly. The details are really, really key. And in so much of the tax world, it's
Yeah.
they have they've got their rules and their processes, and you really need to follow them. And especially when a larger deal like this, when there's a lot of money on the line, it's well worth the fees for your attorney to help you draft up some documents and keep professionals involved, so make sure it's done appropriately.
And there's other ways to try and accomplish it. There's partnership divisions. There's a strategy
Yeah.
out there called a QI note. So, or a buyer, we call it a PIN, uh, purchaser installment note. There's different
Oh yeah.
ways to try and accomplish the same sort of thing. Drop and stop is very straightforward. So
Yeah.
the other ones have some hair on them.
Gotcha. Um, I guess kind of changing gears a bit. Have there been, what would you say have been like some of the more interesting or challenging type deals that you've seen, if not a drop and swap? Are there other types of um, 1031 type exchanges that you work with that are
You do a decent amount of reverse exchanges.
okay?
So the sequence for an exchange, the way the law is written or the regulation is written for a delayed exchange, is you give up the old one, get the money, and buy the new one. It's got to be in that sequence, and that's what most people do because they need the money from the sale
Yeah.
to turn around and buy the new one. But there is what's called a reverse exchange, where somebody's found the new property, they know they want it, but they haven't sold the old one yet. So there's different ways to structure these things, but we create holding companies. It's called an EAT, Exchange Accommodation Title Holder. It's typically an LLC, and it steps in and buys the replacement property for somebody. It's a placeholder, a straw man, whatever you want to call it, to
Sure.
temporarily hold the title so that the property doesn't go away. And then the client sells their property and buys from us, the holding company, that we're just parking the property. So they get the sequence correct, sell and then buy. We're just
Yep.
a placeholder. And there's different ways to structure these things because we could also step in and buy somebody's relinquished property, forcing a sale so that then they're the buyer. And it usually depends on where the money is coming from to buy something ahead of time. That's a key thing, right? Because you ain't using my money. So client's got to come up with the money in whatever fashion it is, either cash or cash and a loan, whatever. Or and what state we're in, because when we step in and hold title to property, we're causing another settlement. I'm a temporary owner, and then we have deeding issues and stuff like that. So we have many strategies we use to get around an extra transfer tax, but we got to be careful with what states we're in that we're dealing with.
Gotcha. Yeah.
And we do a lot of them. I think last month we broke a record. We had 15 reverses that we started up last month.
Oh,
So
wow.
that's a good number of reverses, right?
Yeah. And then there's a safe harbor out there for reverse exchanges that
Yeah, and
basically
that's what we
says,
follow. Yeah,
yeah, kind of
the
sticking that
revenue
180
procedure.
days. Yeah.
Yeah,
Okay. Yeah. I think
and it has its own clock. If let's say somebody wants to sell something, they haven't sold it yet, but they found the replacement, we'll step in and hold title. We'll figure out the money, all that sort of stuff. We'll hold title. We can sit there for 180 days.
gotcha.
So that's
Okay.
the safe harbor. So the client basically is buying 180 days to get rid of their old property and then buy
Yeah.
from us where we've parked it for them
Yeah.
temporarily.
Ever since COVID, it's been, really a tight inventory, right? Just about
Yeah.
everywhere, right? And so being able to step in and find your replacement first has a lot of value to people, right? Rather than try to sell and then go find a replacement, right? That can be difficult. So we're seeing a lot. We feel the uptick in people willing to do that. As obviously it's more complex, right? We're talking about a temporary owner in place. There's more cost from our perspective. So there's a little more planning involved with the reverse, but when you're looking at a different environment, right, and follow what drives it, right? If people think that it's too risky to sell then buy, that's where we start talking about reverse. And you can always pivot there too, right? If your plans go wrong, we can pivot and do a reverse exchange.
Gotcha. Okay. Good deal. Do you guys see a lot of construction exchanges?
Yeah,
They
we
kind of
call
do
that an
exchange,
improvement exchange or
improvement exchange. Yeah.
built to
Okay.
suit. Right? Yeah, we do a decent amount of those as well. And the example is you find the new one, but it needs a new roof or it needs a wing on it, or I'm buying an office condo. I need to do the build out in there. So we'll step in and temporary and get the value up because that's what you're trying to accomplish is push the
Yeah.
value up so that it covers what you sold. So we'll step in and hold, and then the client does the work to do the improvement. We typically make the client the manager of the LLC that owns the property. So they're signing all the contracts and negotiating all that sort of stuff. And then the client buys the finished product. And the reason all this is in place is because improvements added to a property you already own are not like kind, and it comes from an old Coca-Cola case. So the client sells something, there's a big bucket of cash, can't take some of that money out of the cash out of the escrow account and buy the house, hold back some cash, and then buy some shingles to put on the new house that the client already owns. It doesn't work because you're buying shingles, which is personal property. It's not real
Yeah.
estate. Once it's there, then it's real estate. So you got to get it there. So we put our holding company in place to put it in place, and then they buy the finished product.
Okay. Awesome. That
Yeah,
has to also be done in the 180 days too.
that's right.
Yeah.
So
That's right.
I know
I
that.
had a good example. I had a dentist sell out a Reston. It was his office condo. A developer came and took the whole office condo complex, and he took the money from his sale and bought a rental condo in Chantilly, which was cool. And then we took the rest of the money and bought his new office practice in Herndon, and he did the build out. So he took all the
Okay.
money from his sale, got 2 investments and the build out done. So he was a happy camper. Because
Yeah.
if he had just sold his practice because he'd been there forever, a big chunk of his money would have gone away. He may not have been able to afford, without borrowing, the new dental practice and do the build out because so much money was going to go away. So he used all his money, continued his investment into 2 different properties. So that worked really well. It's a great example of an improvement exchange.
Okay. Awesome. Jeff, were you going to say something on the? I thought you muted.
No, I'll add to that. Right, the 180-day clock is the hard part with improvements, right? So when we start talking about that, yes, this is possible, but because we're restricted to 180 days, you're really talking about incremental ads, right? That we get that's a common question we get. Hey, can I buy a lot and build a whole new property on there? There realistically isn't time, right? You almost either have to be really shovel ready on what you ever want to do, or you're talking about incremental additions to what's there.
Okay. Awesome. Good deal.
Yeah, because there's no exceptions in the code if the inspector is sick or the contractor can't get the windows. There's no exceptions in there.
Yeah. Very true. um. So what do you have you run into any, I don't know, like interesting or funny stories or deals that you've come across?
We always have those.
There's always funny
There's always something.
I mean, I'd say there's always the curveball or the hairy scenarios, and a lot of them revolve around things like drop and swaps, right? Okay,
Okay.
now or and this is it always is the last minute. So I mean, a key thing, easy for me to say, right, is the guy who does it, but like the more you can plan ahead of time, the easier all this stuff goes.
Oh,
But that's never how it goes, right? So people already under contract, and then we want to drop and swap. I want to we don't want to divvy up the cash evenly, right? We want to have some person take more cash versus the other, and then it all starts getting complicated. And plus, maybe there's family dynamics in there too, right? That
yeah.
we're inserted into. So those kind of things are happen all the time. And especially if we're under the gun, right? We get the contract on Monday and we're closing on Friday, right? And there's a bunch of questions to answer in between. Then it becomes a bit of a scramble.
Gotcha. Yeah.
Yeah, because not much planning went into it. And because this stuff comes with a clock, you really got to know what you want to do.
Yeah. Yeah.
Hustle.
Definitely. I know when we work with clients that are talking about a 1031 exchange, it's like go out there and start looking at your
Oh, yeah.
replacement properties before you list your property to sell. Because if you're going to do like your standard delayed exchange, it doesn't matter what the market conditions are, the rules remain the same.
Right.
And then, on the flip side of that, I see a lot. It's like, we're about to sell our property. What can we do? It's
Yeah.
like, we still do a 1031 exchange. I remember you telling me about that before, and it's like, we probably depends how far along in the process you are, but
Yeah,
yeah,
a key component, just to go to that detail, is you got to have a QI hired before closing on the one you're selling. So by
yeah,
definition, we're the ones that are actually doing the transfer.
yeah,
Because if you
yeah. That's
sell it
very true.
and you don't own the real estate anymore, I can't help you do a trade of something you don't own anymore. So
Yeah, once
you
you
got to
close,
own it for me to trade it for something else, right?
very true.
And
Yeah.
we can do them very quickly. I think the fastest we've done is like 20 minutes. We got our paperwork.
Oh wow, really?
That's why I have less hair, but that's,
What?
yeah, we're pretty automated on our end. It's all electronic nowadays. So
Okay.
we can hustle and get stuff done. But that goes to the point, there wasn't a lot of planning in
Yeah.
terms of what's happening in there. We cannot emphasize enough that you got to plan. And your point to at least start the discussion about, hey, I may want to trade this for something else is a good one. Then you at least when clients know where the bumpers are, they'll proceed and they know what to do. Another thing that's okay is it's okay to contract for the replacement property ahead of time. You don't have to wait for the closing on the one you're selling to go under contract on the buy side. So this is not about contract dates, it's ownership dates. So in the ideal world, you sell yours on Wednesday, we get the money on Thursday, and then we buy on Friday, and we're done. You've sold and
Yeah.
you bought, but it's all queued up. That's the ideal world.
Yeah. Yeah. The only way that works is like you said, proper planning in place and getting a head start on these things, because without
Yeah,
it,
even if you get down to, what color you want, what state you want to buy, are you going
yeah,
to go, if you're selling residential, you're going back to residential, what are we doing? Are you going to bridge to commercial? Yeah.
yeah,
Just as you mentioned at the very beginning, what what can you trade for? So it's any kind of real estate, like you mentioned,
yeah,
or any other kind of real estate, as long as it's all business investment type property. That usually means rental property, right? You're in the rental business, or investment, which is usually land, like farmers
yeah,
trade land, ranchers, all that sort of stuff. So anything else is not qualified. So no primary residence. You don't
yeah,
exchange a primary. You don't exchange a second home. So if it's personal use and you got the beach house and you got your family and they're goofing around all the time, that's for rich people. They pay taxes. That
yeah,
doesn't qualify as a business use investment property. And dealer property doesn't qualify either. That's held for resale. So builders, developers, they don't do exchanges because that's their intent. They just buy stuff, fix it up, and sell it. That's their
right,
business, right? Cost of goods sold, inventory, that sort of stuff. That's really where the flippers fit. And
yeah,
so, flippers don't like that message. I don't want to pay
right,
taxes, right? But it's just the nature of the business. Now, I've got clients that are both flippers and buy and hold folks. They run both businesses. Our cheap advice is make sure you run two different businesses. I got an
yeah.
LLC that does my flipping business, and I got an LLC that's in my hold business, and keep the two away from each other.
Yeah, absolutely. That's the best way to kind of demonstrate your intent on what you plan to do with that property, is have two separate entities. Yeah,
Right.
that's
Right.
good advice. Yeah. All right. So I think we've covered the basics. We talked about the drop and swap, some other exchange types.
Are you seeing any clients with DSTs? We see a lot of DSTs,
You know
Delaware
what?
Statutory Trust.
I have seen a few. It's probably been a year since my last DST transaction, but yeah, we could talk a bit about DSTs. That's another nice.
Jeff, would you say it's about 10% of what we do, or about 10% of our clients are buying DSTs, Delaware Statutory Trust. So, that's a form of ownership um, that the Delaware Statutory Trust can hold the property, and then they can sell beneficial interests in the trust. And so individuals like you and I could sell something and buy a beneficial interest in a trust that's Delaware Statutory Trust. And that's okay because the government has said it's okay.
Yeah,
So you're not an actual owner of the real estate down at the courthouse, but you are an owner of the beneficial interest in a trust that the IRS works for 1031. So we see a decent amount of clients. That's what they're buying. It's $1 billion space. It is not a small market um, that people are buying into. I'll give you a good example is our office is in Gainesville, Virginia, so west of DC. And there's a big old BJ's box store sitting out there. It's about a $30 million building. That was a DST. So a DST bought
oh
it,
really?
sold beneficial interest in it, right? Like people like you and I traded into it. And then now it's sold. We call it going full cycle. So it's now sold, and all of those people made additional decisions. Go into another DST, go back to your own real estate, or cash out and pay your taxes. So we see a decent amount. We don't see a lot around here because the math doesn't work very well. But the mid-tier cities, the Richmonds, the Raleighs, the Charlottes, a lot in the middle of the country, very common where these DSTs are buying and holding property. And a total mix of property, mixed use, um, apartment buildings, a lot of the triple nets like the BJ's, where the
Yeah.
tenant takes care of everything, the Rite Aids, the all that sort of stuff. They're all very common held as DSTs.
Okay. Yeah. The few I've seen have been kind of like either triple net or like your class A type
Yep.
buildings that
Yep. I
you
don't
know.
see a lot of office buildings, but it's usually the very nicer apartment buildings. Doesn't
Yeah.
have to be, but student housing,
Yeah.
storage centers, all that kind of stuff. All kinds of properties are held that way.
Yeah,
Yeah.
look, it's queued up for clients who are looking for a passive investment, right? I want to keep going, but I don't want to buy
Yeah.
another townhouse that I got to manage the tenants and trash and all that. So I buy one of these DSCs, and then I'm a passive investor. I'm just sitting there waiting for, the DST to sell again, because that's its plan in 5 to 10 years, depending on what the DST is for. And they're built up for 1031 investors. So I mean, they'll sell you down to the penny of what you need to buy, right? We talked about at the beginning. The goal is replace the value of the real estate. Everybody's selling all kinds of different real estate with all kinds of different values, and they can sell you down to the penny of whatever you need. Plus, they'll even have debt there sometimes. So if you need to replace debt as part of your exchange, they'll be sitting there with debt, and that you can assume part of it. So from a planning tool, it's powerful for people doing it at 1031. And there's that moment that's really hard with 1031, is that 45-day ID, right? You got to make a decision what to go do. Maybe you found the right investment. It replaces, using that scenario that Dad had for $500,000. Maybe you found the perfect replacement. It's only 400, right? It doesn't quite get you to where you want to go, and you don't want to expose the $100,000 difference of value to tax. So you go put that $100,000 into a DST as well, right? As part of the overall investment. And so you can have a DST on your 45-day ID, either as like a fill up, so it gets you to where you go, or as a backup option, right? So maybe I want to buy this, but if my contract falls through, I pivot and buy the DST, which I know is sitting there. So it really adds some good arrows in your quiver as you're part of the planning for the 1031 exchange, to have those there, right? Especially in this kind of environment where inventory is tight, right? A lot of things can go wrong, and you got to give yourself options to not end up with a failed exchange.
Yeah, no, that's a good point. Using that as like a fill up if you're a little bit short, or just I think Bill, you'd mentioned getting into like a more passive role, because often, unless you've got a really big property, if you're going to try to 1031 into like a syndication where you could be a limited partner, it's difficult because there's a lot of cost for the promoters to do something like that. So unless you've got a couple $1 million of investment coming in, that they might not be able to help you out. But where a DST, they sounds like they have a lot more flexibility there to allow you to come into a deal.
Well, and it works for 1031 because you can't take your money and put it in a partnership. It doesn't work, right? It's not like kind.
Can't go buy.
It can't be a syndication. So.
Yeah, but I've seen syndications where they'll kind of
buy as tick
that. Yeah,
right.
They let you kind of 1031 into that, but they usually require big investments.
They're hard, right?
Yeah,
they're hard. Right.
Right.
Yes, usually the clients that are buying DSTs are older clients because they're tired, right? I own a rental property. I've been dealing with all the issues for rental stuff.
Yeah.
Why should I just move my rental property up the street and continue my headache? I'm trying to avoid that. I'm getting tired. So these passive things are sitting out there, and that's usually who we see are buying them. And their plan is to hold them, continue the DST investment. Maybe it's a different one later, et cetera, and then let them pass them on to the family when they pass away.
Yeah, that's good tax planning right there for sure.
And they come in all kinds of flavors. It's not just one building. Sometimes they're sold in a portfolio. There may be 5 Burger Kings into this umbrella, right? So then you're getting diversity in different markets. All that kind of stuff is in there as well.
Yeah.
So it's all, and then there's different sponsors out there. So we got clients that'll break it up into, I say sponsors, the owner of the building that's managing the building. And so then they'll break it up into different sponsors, also spreading out their risk as well. So see all kinds of strategies. Yeah.
And to add one more layer to it. I mean, we're kind of getting the nuance here. There are now what we call UPREITs, right? So you got that challenge, right? You can't go buy into partnership interests. But, knowing what we've talked about, right, with the held for investment criteria, there are these DSTs that are structured to eventually become a REIT, right? So you can buy real estate and end up with shares of a REIT because you'll buy into the DST. It'll be a normal DST. They'll hold for 2 years. And then based on their plan, they'll either give everyone the option, or just everyone knows when they buy in, this is what we're going to do. Now, all the investors in the DST do a 721 exchange. So you're doing a combination. 1031 exchange, real estate for real estate. Then you're doing a 721. You're contributing your real estate into the investment, and then you end up with shares of the REIT. So it allows you to end up with something theoretically more liquid, right, into something else. And so there's a lot of those now. Some really big sponsors have come out with UPREITs as we see them, right, or 721 DSTs. A lot of different names out there.
Yeah, I see that online a lot, the 721 exchange, and I've started using it myself as well, because really the 721 exchange is really just a partnership contribution.
Yep.
But when they say that, it's really like what you just described, going into the DST there's a holding period, and then you get into the REIT, which I think is through in like an operating partnership
That's right.
structure.
Yeah.
Yeah.
Yeah, the key thing to remember with the 1031, one of the big benefits is you can exchange and then you can exchange out, right? Your real
Yeah.
estate, you still have real estate. If you do a 721 exchange, now you own interest in the company, right? You don't
Yeah.
have real estate itself, so you can't exchange out of that, right?
Yeah. It's kind of like the end of the line there.
Yeah, but still is effective planning tool.
Yeah, for sure. Yeah, absolutely. All right. So I don't, any other interesting 1031 topics you guys think we should touch on? I know we're getting close to time, but this is we've covered a whole lot of really fun stuff. So
Yeah, do you want to talk about cost segregations, bonus depreciation,
yeah, okay.
how that affects things now? I mean, because that's something key that came up in the 2018 tax bill or 2017 tax bill, right? That honestly, and this is inside baseball, it was a fight there in Congress to keep 1031 in the code, right?
Yeah, I remember that.
There were a lot of efforts, including Dad there, to make sure that to educate Congress, and so we survived from a not being included as a pay for. But one of the things that came out of that was this concept of bonus depreciation, right? You can go through and reclassify your real estate, right, to 1250, make it personal property 1245, and then take depreciation right away, which they've now put into the code kind of forever, right? 100% bonus depreciation. So
Yep.
what that means though is fundamentally your real estate's a powerful tool, right? You can go in and do a cost segregation study, write down a ton of valuation right off the bat, right? Depreciate it on your books much faster. When you go to sell, you gotta keep in mind, this goes back to that, easy for me to say, but the planning that's there. When you sell, you now have two different types of property. You have 1245 and 1250. So part of the 1031 exchange, you actually have to replace like kind real estate. The detail there is you now have to replace two different numbers. You have a 1250 property you have to go buy, and now you have 1245. If you don't replace it with other 1245 property, the amount you've depreciated with bonus depreciation, you will expose that to depreciation recapture. So there was a family out of Arkansas who exchanged a hog farm a couple years ago. Big case. They had a hog farm, had the acreage, and then basically the land wasn't worth that much. So they had most of it was depreciated through cost segregation, right? Where all the hog barn, the fences, all the stuff on their property. Well, they sold their investment property that they had depreciated through with bonus depreciation in Arkansas, and then they just went and bought a condo in Florida. And so just did a normal purchase of a replacement rental, and they lost the tax case because they came back and said, you didn't replace your 1245 property. You only replaced it with regular real estate. You didn't do a cost seg on the other end. And so they had to come back and pay their taxes. So, but it was a clear case of, hey, this is a detail that a lot of people don't think about. This is, it's a lot of benefits to taking that depreciation up front, a lot of operating reasons to do that. There's even the strategy of a lazy 1031 that floats around up, right? Rather than doing a 1031 exchange. But when you're selling the property, now you have two different types of real estate on your books, and you got to think about that.
Yeah. Yeah. That's a very good point.
And you get to deal with it because on the 8824, when somebody does an exchange, there's new lines for 1245, which weren't there before. And that's only come out in the last couple of years. And the instructions to follow are terrible.
Oh, yeah.
I don't know how you guys are going to figure it out because it's rough.
Even by the standards of IRS forms and IRS instructions, the 8824 is a rough one.
It is. Yeah, it really is. It's one of the more complicated forms to handle. But even, sometimes it's like you look at it and you read what they want on the line. So I know what numbers need to go there. The numbers are here. It's like, but following their instructions is sometimes a little not quite so straightforward. But
I don't know how many hours I have in analyzing that 8824 to get the numbers right. It's just a monster.
Yeah, it definitely is. Not fun, but yeah, that is a good point. The depreciation recapture when you use bonus depreciation, that's all coming back as ordinary income too.
That's right.
Not the 1250, which is limited to 25%.
Right.
So there's trade-offs to all these things. Like it's great to try to use things like a cost seg study and bonus depreciation to lower your tax bill, but you have to understand like what that does going forward
down the road. Right.
Yeah. Still works fine, just as long as you plan for it, right?
Yeah,
Just,
exactly. It's like with everything, there's trade-offs. So just being aware of it and properly planning. So All right. Anything else you guys want to cover? Or?
This is all we do is help people with exchanges of every size you can imagine, giant ones, dollar wise, and small ones. I think the biggest one we've done, Jeff, 800 and something million bucks, right? And then I think the smallest one I did was back when we did equipment exchanges. We had a guy sell the bass. He was one of the players in the National Symphony Orchestra, and he
Oh,
traded his bass to the guy next to him in a seat, and he bought a new one. That was the exchange. He gave up his old bass because he had been depreciating. It was his business equipment
yeah.
into this new bass. So I think that was 30 grand was the smallest one. I just did it for fun, just to learn what the hell to do. So, but we do them every flavor all over the country. Right?
Awesome. What is the best place for people to find you guys? Is your website 1031.us?
That's exactly right.
I'll put all your info in our show notes, but if there's anything else you want to throw out there, we can just feel
Yeah,
free.
and we're more than happy to chat with clients. Don't be afraid to call us and, hey, here's my scenario, and we're more than happy to go through it because I've learned over all these years, the more clients know what it is, then and we get rid of the mystery of this thing, then
Yeah,
they can proceed for sure. And we have plenty of good material to send out. We've translated it from legalese and text language into English. And
gotcha.
so trying to guide people into the basics, right,
Yeah.
what it
And
is.
and talking about this all day is what we do, like that said. So yeah, hit our website. We got a lot of content there. But a key thing then, this is part of when grandfather started the company, right? Is when you call us, you'll get a human will answer, right? So that's
Yeah,
a big piece is being able to chat with people. So even if this client just wants to ask questions,
yeah.
we're a phone call away, and we strive really hard to make sure we answer the phone and we're there, and you can always talk to somebody even if we don't have the answer right away, right? We'll help get you there. It can be difficult now finding the right answer, especially in the tax scenario with AI and all these things out there. It's
Oh, yeah.
it's a lot of jumbled information. So but from our standpoint, this is all we do. So we're a phone call away, and we're happy to act as a resource.
And we're very plugged into the industry. I mean, I did a ton of lobbying in 2017. I think I spent every 30 days up on Capitol Hill trying to protect 1031. So we went through all of that lobbying up there, and now Jeff does it. And
Yeah.
so he has stepped into the role of lobbying, and he's on the path to being president of our association. So we're very plugged in and have lots of resources to reach out to at the national level.
Okay, great. Yeah, that's awesome. All right. Well, I appreciate the time today, guys. It's been really interesting. I learned a lot. I had a great time. Really appreciate you guys coming on. Again,
Thank
I'll
you
put
for the
all your
opportunity.
absolutely. I'd love to do it again sometime. And we will put all of your contact information in the show notes, and I'll let you know when things are gonna go live.
Perfect.
I
Thank you.
appreciate it. All right.
Stay
That about
cool.
Yeah, you as well. That about does it for today, everyone. Thank you very much. If you found value in this episode, please hit that like and subscribe button. And until next time, have a great day. One last thing before you go. We have put out a free ebook for our listeners. You can find a link to this in our show notes. It's called the Rental Real Estate Investor Tax Guide and covers all the basic tax related information for real estate investors. We hope you like it. Again, go to the show notes to download your free copy. So that about does it for this episode of the CPA Zone. Thanks for listening, and I hope you found something valuable that you can take away. We are taking on new clients, and if you'd like to work with us, then go to our website and fill out the client intake form on our contact page. This can be found at thepulisgroup.com/contact. That's ThePulicegroup.com/contact.